Come on in, sit back, relax, and listen to episode 147 of the Wealth Tech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features interviews, news, and analysis on the trends and best practices all around wealth management technology. Now, our topic for this month is ESG data. So we chose this topic because it's an area of a very hot industry trend that really wasn't getting enough coverage in the media that we felt. And we always want to know more about how the sausage is made behind the scenes in industry trends. And ESG data seemed an interesting area for us, how it works, how they gather the data, how the data is analyzed and organized, since it has been driving a lot of investment decisions recently. A lot of firms are saying that ESG should drive investment decisions, but the question is, how do you get the data and where is it coming from and is it reliable? So I met today's guest, Ben Webster, who's the founder of Owl ESG, at a VC event where a number of startups were pitching for funding. And I found Ben's presentation really compelling, and I grabbed him after the conference. We talked for a while, and we've pretty much been talking ever since. Now, we not only did this interview, but we're also co-authoring an article on the use of ESG data in wealth management that will be coming out in a couple of weeks. But before I get into any of that, allow me to first expound on how important data is to the success of any ESG initiative or any technology-driven program for that matter. And this is why Ezra Group launched our data assessment service for enterprise wealth management. We conduct an in-depth a review of the current data sources, downstream consumers, data utilization, and data infrastructure for any target area of your firm. And then we deliver a comprehensive strategy and roadmap to get your data architecture under control. For more information on Ezra Group's data assessment service, please go to ezragroupllc.com. A couple of quick housekeeping notes before we continue. Please subscribe to the show wherever you listen to podcasts so you don't miss an episode. Make sure to check out our sponsor, the Invest in Others Charitable Foundation at investinothers.org. And now, let's kick this thing off. I'm really excited to introduce our next guest. It is Ben Webster, co-founder and CEO of Owl ESG. Ben, hey man, welcome to the program.
Hey, thanks for having me.
I'm glad we can make it. We just saw each other in person back at the T3 conference. Great to see you.
It was great to meet you in person, and that was an amazing event and met a lot of amazing people.
And I met a lot of people I know and people I didn't know, and just it was great being around people and hanging out and getting that in-person interaction, sort of serendipity, walking around the trade floor and running into people you maybe didn't know, which you don't get on Zoom. So it was all good. And Ben,
it's my first time there. I really enjoyed that as well.
It's always nice to see first-time people and see what they think of I think it's my 8th or 9th T3 conference, but yeah, it's a big one for our industry. So where are you calling in from, Ben?
Los Angeles, California.
Excellent. You sound great. I'm in on the East Coast, and everything's great over here. But let's get kicked off. Can you please give us the 30-second elevator pitch for Owl ESG?
So Owl ESG is an environmental, social, and governance ESG data and analytics firm. We work with a wide variety of institutional investor clients across the world: hedge funds, large asset management platforms, banks, insurance companies, financial technology platforms, advisors, wealth managers, and so forth and so on. And what we help them do is to make more impactful investment choices with the latest and greatest ESG data available in the market to help them serve their client mandates.
So one of the reasons why we're talking and why we've been talking is there's no one ESG data source that everyone uses. There's lots of them. So can you talk
Correct.
about what the impetus was for your company and how you are solving some of these problems with all the different providers of ESG data?
Yeah, happy to do that. So kind of story goes back, a decade approximately. My partner and I, Andrew Smith, we wanted to start a investment management company, primarily an ETF company. And we identified ESG, impact investing, sustainable investing, is something that we're both passionate about, and decided, hey, we need to figure out how to execute this in an index that would power ETFs. We were looking at many different options, including creating our own data, but decided to first start by talking to the predominant ESG data and analytics providers out in the market. And without naming names, we started to get access to some data from a number of them. And we quickly identified that ratings were very subjective. So a good example of what I mean by that is, if you look at a bond rating, right, credit rating, right, and you look at the ratings from S&P Global, Fitch, Moody's, or others that exist out there, and you compare them, any two of those bond rating firms, they're typically going to be above a 95% correlation. That means if any given company has a good credit rating, like say an A or a triple A with one credit rating agency, it's going to be right around there with another, right? That wasn't true with ESG ratings. Any given company could have a great ESG score, or a great E score, S score, G score, or other types of ESG scores. And those similar scores could be anywhere from poor or dreadful with another provider all the way up to great as well. And so the correlation at that time was somewhere in the low 30% correlation, which we translate that to mean that's highly subjective, right? And so, I come from a physics background. My partner came from a finance background, but with a heavy emphasis on data science and stats and math, what have you. And it just didn't sit well with us. We were like, we can't use these metrics, because if we work with this one provider, this company would not be in our index. We worked with another provider, that company would be in our index. And we just couldn't sit with that. So what we decided to do is well, you know what? Let's see if we work with multiple providers to create a consensus score that was ours, that we could then power our ETFs. And we spent a number of years trying to launch an ETF company while we had created our own consensus scores to solve that subjectivity problem. And that's kind of where the origination of our metrics, our core product, the AL ESG consensus scores, came from. Was we wanted to build investment products for ourselves, and the scores ended up having such resonance with anyone we spoke to about them that we just decided to become a data company.
It makes a lot of sense. You were scratching your own itch and decided it was something that you could then sell to other firms.
Exactly. So we created those scores because, to solve our own problem. But if you really think about it, right, if we decide to create our own ESG ratings based off of our own, and we can go into why the ratings are subjective in a sec, but created our own ratings based on how we looked at the world, we would just be like any other provider, creating our own subjective view. By doing what we do and aggregating hundreds of sources and many of the largest ratings providers, we then can do something that takes it to the next level of objectivity and rate based on consensus, much like consensus earnings estimates are used to generate consensus from multiple subjective opinions of analysts on where the earnings are going to be for a company in the future. And so that's kind of what we decided to do. And I'm happy to get into why ratings are subjective, if that's of interest to you.
Absolutely. I mean, I really like to know that. So when I look at a lot of these data sources, I can't figure out how they're deciding which of they like MSCI has 35 parameters. How they decide how to weight them, how they decide where the data is coming from. Is that data clean? If you got 35 subjective data sources, you're bringing into one score. How can anyone trust that score matches what any investor would think is a valid ESG number?
Yeah, and so that's a great question. And just so to be clear, we're a big fans of what all the ratings providers do. It's hard. So let me tell you why what they're doing is hard, what Morningstar is doing that's hard, and all the other providers out there. And I do want to give them credit where credit's due, right? One of the main reasons why it is subjective is because ESG disclosure is not regulated. It's not like when you have credit ratings, they're all looking at regulated, mandatory financial disclosures that all companies have to disclose. So the credit rating agencies are working with a very consistent data set that, for the most part, and we know there can be shenanigans that go into the companies can do to make themselves look more solvent than they are, and we all know that. But those are all known things that are pretty much people doing credit ratings know about those, and they've developed techniques on how to deal with it. But they're all looking at a very standardized data set. And so Moody's and S&P Global and Fitch and the others all looking at the same thing. The problem with ESG disclosure, because it's not regulated, any given company, like the companies that ESG ratings and research firm would be evaluating, they can report. They don't have to report anything. They can report on some things and not others. Two companies in the same industry can each be deciding to report on certain ESG metrics, but the metrics that one oil and gas company reports may not be the same ESG metrics that another oil and gas company reports, right? And when I say metrics, I'm so themes like carbon data, water waste, whatever it may be, they're not reporting on the same thing, and they're not reporting them in the same ways. So they could both be reporting on carbon emissions, but maybe one's reporting on total carbon emissions and one's reporting on certain subsets of carbon emissions, or they'd be putting them into goals, not into past performance, right? And it's not even audited, right? So that's difficult. And so what you end up getting is, if you're someone in an ESG ratings firm and you're trying to go, okay, let's figure out how we're going to rate oil and gas companies, or how we're going to rate trucking companies and shipping companies, and how we're going to rate chip makers, right? You're looking at any group of companies within a segment. Let's just say stick with oil and gas, and the data is completely inconsistent. There's blanks everywhere. It's not standardized. How do you create a standardized data set, standardized ratings, when the raw materials are so all over the place, right? So by nature, they have to take subjective leaps. They have to go, okay, how do I rate British Petroleum, and how do I rate Exxon on let me give them an emission score, AAA on emissions, or whatever it may be, when they're not scoring the same thing, and they have to take subjective leaps. They don't have the same raw data, They have to take subjective leaps to do that. So that's where the issue arises. Each of the different ratings firms make ultimately different subjective leaps, and they all have their reasons for making those subjective leaps, and frankly, they change it over time. They try to get better, or in some cases more marketable, or in some cases maybe they cut corners. In some cases they don't. Right? Without pointing at any given firm, it's tough no matter how you slice and dice it, and it's a difficult issue. And so what we're trying to do, cut through all that noise and go, source one, this is what they think about British Petroleum. Source two, this is what they think about British Petroleum. And what's the differences in what they think? And what are the similarities in what they think? And when I say but what they think in regards to how British Petroleum is managing certain ESG risks and opportunities, right?
So Ben,
how is British Petroleum managing their pollution risk, right? How are they managing their risk in the local markets they work in, and how they're destroying the environment or helping the environment in where they're drilling, where they're selling, all those types of things, right? We are seeing on that topic and topic by topic how source one and source two agree or disagree on how British Petroleum is doing.
Hey,
And
Ben.
so we're taking those advanced,
Hey, Ben.
we're looking at this deeper and trying to isolate where the sources agree and making a standardized data set that's usable, clean, consistent for clients.
I want to take a little break from this episode to talk about our sponsor, the Invest in Others Foundation. The Invest in Others Foundation is a 503c charitable foundation, and they work to raise money to donate to charities that are sponsored or supported by financial advisors. And I've been working with these guys for a number of years. And I'm also honored to be on some of the judging committees that decide where the money goes to which charity based on the advisor's work. And we have a number of really interesting, really well-deserving charities. We get 10 each time. We have to pick just one to get the money, at least to the main winner. Then the rest get some sort of follow-on prizes after that. But it's really interesting, and it's very difficult to decide. There's so many good charities. That's why I'm always trying to raise more funds for Invest in Others. We really want to give money to all of these charities. The judging that I did recently was for the Community Service Award. That's for local charities only, not national. There's also global charity awards for overseas charitable work, and the national U.S. awards for larger organizations. But this is just community-based charities. It was really difficult. There's some great opportunities to help people all over the country. So that's why I suggest you go to investinothers.org and make a donation now. Hopefully your company can match it. Investinothers.org. That's cool. There's a lot to unpack there. So can we talk about how many
Sure.
data sources are you bringing in?
Over 600 at this point.
I didn't realize there were 600 ESG data providers. Are they all equal? Are they all the same? There's numbers.
So there's probably like 50 or 60 ESG data providers in there, but like around 13 or 14 major providers in there, and then a whole bunch of specialists. And then the remaining sources are other types of companies, NGOs, nonprofits, and so forth and so on, that they're not ESG data providers, but in the process of doing what they do, they are collecting data points that are ESG data points, right? Like, for example, a nonprofit that may be working with the clothing manufacturing industry and are consulting with those clothing manufacturers on how to make their supply chain conflict-free and free of labor violations and so on and so forth. So in the process, that and nonprofit or whatever type of entity that we're working with, they're gathering that data to do what they do, and that exhaust gets given to us.
What is your tech stack? What did you build in the back end to make all this work?
Yeah, it's very much cloud-based. We run it on AWS. We're using Python and a lot of the tools available in Python. Essentially, it's a big process in data science, analyzing our different sources and running regression analysis and determining correlations to again identify, when each of our sources look at a company, what is the ESG view of that source on that company, and how does that compare to the view of source by source on that company.
And the regression you run, you're trying to determine the overlap between the different sources.
Yeah, exactly. Determine, hey, for this company over time, have they been looking at, for example, board diversity or water waste or CO2 emissions and other emissions, or gender pay gap, or whatever the ESG issues that they rate, right? Over time, has this source and that source continued to look at that issue as something that they're scoring for that company, right? And sometimes there's issues where just because they call, like if you look at a certain source and they may call it emissions, another source may call it carbon emissions, right? And they're rating those issues. Are they the same thing or are they different, right? So we're doing a lot of analysis of that type to identify, how correlated those two are, and that determines a degree of consensus on that issue, are they in agreement or not agreement, right?
Cool. So how does so you got your data science, your advanced statistics, you're running regression, you're detecting correlations to identify commonalities between sources and determine the overlap of the relevant ESG statistics. So what do your clients do with this output?
Yeah, there's a lot of different types of clients, and I know that we've got a lot of hedge funds, large asset management shops. We got ETF issuers that use our data, and what they're doing essentially is constructing investment product, right? A lot of that clientele is looking at our data and trying to find some sort of risk mitigation or some sort of alpha. They also use it sometimes to constrain their universe. So, for example, we only want companies that are in the top 50 percentile for their industry on our diversity and workplace rights score, right? Oh, I want to make sure that all companies in the bottom quartile on pollution prevention and climate change score are not in my portfolio, right? Things like that. So they're doing it to construct the universe and screen out or screen in companies into their universe as well. So that's used, and they're doing it for reporting. So when they sit down with investors, we have a lot of in the wealth space, in the wealth management space, and the advisory space, like people sit down with their clients, and advisors or wealth managers sit with their clients and go, hey, what's important to you? Do you care about pollution prevention, climate change? Oh, you do. Do you care about management ethics? I do, but not as much. I'm fine not looking at that metric, right? Or having companies that may score poor on that, because I really care about pollution prevention, climate change. And so the long and the short of it is a lot of advisors work with a lot of female clients. It's huge amongst female investors, millennial investors, and younger generation investors. And a lot of RAs and wealth managers are trying to future safe their firms, right? Knowing that if you invest in serving those demographics and doing a great job on it and building your practice around what they care about, and they very much care about ESG, that they're going to have better client retention, a lot more asset management growth, and building a bigger and better practice, right? And you need to engage with those clients and ask them, well, what do you care about? Let's look at what we can measure with Al's data, and let's see of those ESG themes and issues, what do you care about? And let's build a portfolio and choose funds or stocks or bonds according to what matters to you.
And what matters is that different investors care about different issues. So what's the most important thing that you need in your data to be able to support those investors?
It's a great question. What I would say is that the most important thing is giving them an easy means of having conversations with their investors and determining suitability, right? And then reporting on it, and ensuring that you engage regularly with them on whatever your updates are, whether they're annual update meetings, quarterly update meetings. I think that the best means for doing that is through some sort of software as a service application. We are launching our own soon, but we work with a lot of other financial technology providers that embed our data into their workflows, and allowing, for example, we work with FI360 at Broadridge, allowing the plan fiduciaries that are in that system to build their 401k plans based on choosing funds that are better than peers on different ESG metrics, right? And so it's really that data that allows easy personalization and reporting that is the highest and best use, at least for the wealth and advisory space.
Yeah, I can imagine that having that ability to easily personalize your portfolio, no matter where it is being held, could be extremely important. What about having a wide securities coverage and a wide data coverage? Does that help in customization?
That's really, really important, and I'm glad you pointed it out. So I think the biggest issues with the category of ESG data that's called ESG ratings, right, is the subjectivity we've already addressed. But the other two is coverage and lack of having fresh, updated data, right? Starting with the coverage, right? Typically, most providers cover 6,000 to 8,000 companies, right? And they may cover some funds, what have you. Al covers almost 30,000 companies, right? Which is like 99% plus of the world's market capitalization, right? We also we cover approximately 60,000 mutual funds and ETFs and their various share classes, and we cover starting in a month and a half, we're going to be covering about 260,000 corporate bonds. So we can cover a wide variety of the portion of the portfolio, both in fixed income, funds, and equities. And so that coverage is really important. But what's also really great is that we update monthly, because we have hundreds of sources powering our scores for any given company. There's always some source giving us some data to give us a fresh view on a monthly basis and update the score. The typical ESG rating vendor, they will score the average company once a year. So it's you would never make an investment when you're analyzing a company that's where you have the latest information about them on earnings or sales growth or anything like that was 12 months lagged, right? That's what's going on. And so what we have is the freshest data in the industry, the most objective with the widest coverage.
But you don't generate any data on your own, and you don't override a source. You just review the sources, aggregate them, and maybe provide some sort of credibility analysis.
Yeah, the credibility analysis is internal, but yeah, for the AL ESG consensus scores, we are not overriding anything. We merely identify consensus and make sure that the data that's powering us is quality. So if we're detecting abnormalities, in the underlying sources data, our credibility analysis being internal, what we're doing is we're trying to identify bad data, not subjective data, bad, incorrect data that that we can eliminate from the optimization process and the aggregation process. But ultimately, what we're providing to the client, it doesn't have any of our subjective viewpoint on, hey, is this company ESG or good for the world or bad for the world or what have you. It's merely, this is what the market of the world's leading ESG data providers, this is the market view on what this company is, how this company is doing regarding to ESG, right? That said, you asked, do we have any of our own data? We actually do have our own data, but they're completely separate products, right, that are parallel to our consensus scores. But we also provide what's often called screening data. If you want to stay away from companies that are involved in animal testing or fracking, palm oil, weapons of mass destruction, whatever it may be, and this is more of an ethical viewpoint of the world, meaning, hey, that activity may not be illegal, but I just do not want to be invest in companies that's what they're peddling or that's what they're doing, right? So we call that our screening product, our ethical or principles-based screening product. We also have a controversies product, and that controversies are things like, is the company embroiled in any litigation involving things like oil spills, environmental catastrophes? Are they involved in litigation about human rights litigation, labor litigation, corruption, like like accounting fraud, bribery, those types of things. And last but not least, we have a whole bunch of carbon data. So if people want to directly look at, alignment with the Paris Accords, or carbon emissions and lowering their carbon footprint, that is a separate data set that we do provide. But to be very clear, it's a different data set that can be used in conjunction with the consensus scores, but has a completely different process in its creation and maintenance.
Ben, you have said it all, and we have run out of time. Can you tell people who are listening where they can find out more about your company, Owl ESG?
Yeah, you can find us on obviously the web at www.owl, OWL, like the bird, ESG.com, owlesg.com. You can find us on LinkedIn, Facebook, and other social platforms.
Great. Ben, thanks for being here. Really appreciate your time, man.
Thank you so much for having me. It was a blast.
Hey, it's Craig again. Here are my top 3 takeaways from this interview. Number 1. Hey, it's Craig again. Here are my top 3 takeaways from this interview. Number 1, ESG ratings are highly subjective and updated infrequently. That's why the data needs to be massaged, needs to be analyzed and in great detail. Also has to be correlated and reviewed by some very strict methodologies to make sure that you're getting data that is useful. Number 2, Owl ESG covers over 600 data sources. Now, only 13 or 14 of them are major, and there's lots of specialists plus other types of companies like NGOs that collect ESG data points, and Owl brings in data from all of those. And finally, number 3, Owl covers over 30,000 companies, 60,000 mutual funds and ETFs, and 260,000 corporate bonds. And the data there's updated monthly. Seems super useful for any firms looking to bring ESG data into their investment processes. And that's it for this episode. Please go to our website, ezragroupllc.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you'll receive an email chock full of wealth management goodness, news, analysis, information links, and all that good stuff. You will not be disappointed. Thanks again for listening, and talk to you all again next time.